everyone. Now for topic 9, we will cover working capital management. And if you can still recall, this is the third area under corporate finance. Corporate finance involves three important decisions. Firstly, the capital budgeting. Secondly, capital structure. So we have covered both of them. And now the third area would be the working capital management. I divide this topic into three subsections, starting from the cash management, followed by the net working capital management, which is the operating cycle and cash cycle, and then followed by the inventory management and accounts receivable management or credit management. Now let's start with cash management. Now, first and foremost, we need to understand the reasons or motives for holding cash, right? So holding cash is not just for transaction motive, which is the third motive. So this is a logical and most commonly known motive or reason, okay, for holding cash, but also as a speculative mechanism, right, whereby you can take advantage of the surplus, okay, in cash position in order to invest, right, and generate some returns, okay, for the company. And the other reason would be precautionary. Okay, this is more of an emergency fund, okay, in case of an emergency need arise. Okay, so these are the reasons. Now, if let's say companies want to use the cash to invest in for short term, okay, so they have this money market, okay, as an option where they can invest in financial instruments with short-term maturity, short-term period. So normally 1 year or less. Normally this is to for seasonal or cyclical purposes, right? Depending on the nature and the life cycle of the business, right? You can actually plan ahead and do this to plan for the company's cash needs and expenditure needs, right? And if you look at this is an example, right, of okay. So this is an example of okay, of how you can plan. This is a typical company, normally manufacturing, right, company that have seasonal demands. When you have a seasonal demands, your cash positions would fluctuate, and due to these fluctuations, right, you can plan ahead and come up with a means on how to cover the deficit. Right? The deficit can be covered, okay, either by borrowing short term, okay, or have a long term debt or borrowings. Okay? But please bear in mind, okay, that if the needs are short term in nature, say payables, okay, for example, then you should match it with short term financing. Okay? Whereas if the needs are of a long term, okay, it should be financed by long term debt, okay, for example. So if you look at the chart, right? So we have these both components of long-term and short-term financing, and the line here refers to what we call the permanent, okay, financing, okay, whereas the fluctuating financing refers to the temporary financing to cover the cyclical deficits, right, in the business. Right, if we look at the short-term financing alternatives, okay, through short-term financial securities, okay, normally these are the characteristics. Okay, so the maturity Normally it's up to 90 days, okay, or even less, slightly more, right? And you need to look at the risk. You measure the risk and compare it with the uh, long-term financial instruments or long-term debt. And of course, in terms of liquidity or marketability, it is much more liquid. It's much easier to convert the assets into cash, right? And some of them have different characteristics, tax features, compared to long-term instruments. Now, the best way to keep track of the cash inflow and outflow is by referring to the items in the balance sheet. Okay? And based on the balance sheet identity, the left-hand side is the assets, and the right-hand side would be the liabilities and equity. Right? And the best way is to look at the movement, whether there is an increase or decrease, to determine whether there is an outflow or inflow, right, in terms of the funds, asset, or cash flow. So, for example, there is an increase in the asset item. This is fixed asset increased by 20 million. This shows that over the year, okay, during the year, there is an outflow, okay, or use of funds, okay, by that much. The other hand, if there is a decrease in the fixed assets, okay, by 10 million, okay, this is a source of fund for inflow. Because when the asset value decrease, it shows, okay, logically, okay, it shows that the company has sold, okay, assets by that amount, in this case 10 million. Now, on the right-hand side, okay, either the liabilities or equity section, okay, any increase in the item, say, for example, the long-term debt, an increase by 15 million shows there is an inflow of 15 million over the years to reflect the new borrowings made. And a decrease of 10 million shows that there is an outflow. Okay? A reduction in debt means you make a repayment, okay, for the debt. Okay? Okay, let's move on to the operating cycle and cash cycle. Okay, you have calculated this in the financial ratio. When we do financial ratio analysis, we have calculated the inventory period and also accounts receivable period. Okay, in order to calculate the combination of both would be the operating cycle, right? So the inventory period, okay, plus the accounts receivable period is the overall operating cycle. Now we can also break down, okay, the operating cycle, right, into accounts payable period and the cash cycle, right? So accounts payable period is calculated much the same way as you do when you calculate the inventory period, except now we use the accounts payable. Okay, we use cost of goods sold divided by accounts average accounts payable. Find the accounts payable turnover. Then you use 365 days to divide with the accounts payable turnover to calculate the accounts payable period. And the difference between the whole operating cycle, okay, you minus it with the accounts payable period, the balance would be the cash cycle. The cash cycle translate or give an indication as to how long do we actually fund or finance our inventory, right, in the warehouse if it is a manufacturer, right? So this is another graphical depiction here of the cycle, right? So given that cash cycle is the difference between the operating cycle and accounts payable period, right? So we would, as much as possible, would like our accounts payable period to be stretched longer, right? To be stretched longer, so that we would, as much as possible, would like to delay paying to the suppliers. Okay? And for the collection period, if you can still remember from the previous earlier topic, okay, we would like to collect as soon as possible. Okay? We want it to be as short as possible for the accounts receivable period. Now let's go through an example. Now say you have a beginning inventory of 200K, okay, and ending is 300K, right? And this is for accounts receivable. These figures are for accounts payable, and we have 1.15 million sales, okay, for the current year, and we assume that the whole sales figure are credit sales, and cost of goods sold stand at 820,000. Now, for inventory period and receivable period, you have done this, so there shouldn't be any problem. Okay, after finding the two, you add them both to get the operating cycle of 168.4 days. Now, for the payables period, okay, you calculate the average payables, and before calculating the payables turnover of 9.37 times, and your payables period is 38.9 days, right? So the cash cycle is the operating cycle minus the payables period, okay, stands at 129.5, almost 130 days. So in essence, effectively, we are financing our inventory for 130 days. If let's say the payables period is longer, right, say about, let's say, 60 days. So we deduct from here 20 more days, so the cash cycle will be shorter, right? So the shorter the cash cycle, the better it is for the company. And finally, let's go to the inventory, and afterwards the accounts receivable management. So inventory management, I think you have learned much of it. You have learned quite a great deal in operations management, right? Where you need to assess, to analyze the importance of, first, in terms of your order quantity. That would later have an implication to how much you carry or you store in your inventory, because both have cost. So there is a trade-off, right? There is a trade-off between the ordering cost and also the carrying cost, right? So you need to find what we call the optimal, okay, optimal order quantity, okay, the true star, in order to minimize the cost, right, and also to maximize the profit. So this is an example of what is in store in the inventory, right? It can be raw material, work in progress, or even finished goods, right? Example, when we did 7-Eleven last time, their inventory mostly are finished goods, right? And okay, these are examples of carrying cost. Okay, what kind of cost or what do you incur when you store the raw materials or the inventory in the warehouse, right? Not only in terms of the storage cost, but also in terms of the transportation cost as well. But if you do not have enough, okay, in the inventory, there will be a shortage cost, right? So you need to restock, or even worse, you lose sales customers due to shortage, right? That's why we have to consider both types of cost. Now, in order to minimize the inventory cost, right, cost involved, okay, in inventory management, we have several techniques, okay, or approach. We have the ABC approach, EOQ, and derived demand management, such as the MRP or JIT, in just in time. As I said, you have learned this in operations management. ABC is when you classify, okay, inventory maybe according to cost, demand, or need. Then you sort them according to the value or the priority. Okay? For example, in terms of cost, okay, which one would be the most prominent, okay, in terms of cost per unit? And sometimes you associate it with the sale value, right? So that at the top or upper section, okay, of your analysis, you prioritize the most important inventory, followed by the less important inventory, so that you would know which one would require more urgency in terms of you want to reorder, for example, and when you work out with your suppliers, okay, in terms of the track and whatnot. Now let's look at the EOQ. Okay, you have done this, I believe, right? So it shouldn't be difficult, okay, except that for in finance, our um, focus, okay, or we stress on the cost implication, right? And I believe in operations management also you calculate the same thing, okay, which is the economic order quantity using this model, okay, whereby we need to calculate the total carrying cost. So you need to know the carrying cost per unit and also what is the average inventory level. And for the reorder or restocking, you need to know the fixed cost per order. Every time you order, what would be the cost, which is F here, and also the number of orders, how many times you order in a year. Right? And the trade-off between the two, or the combination between the two, would determine the total cost. From here, you can determine the economic order quantity to determine what would be the size of order, okay, that is most optimal every time you order. And after determining this, you would know that how many times actually you would have to order and what would be the cost. So this is the graphical representation of the trade-off. Right? As the size of order increases, right, it will increase your carrying cost, but your reorder cost would be reduced, okay, or minimized. So the interaction between these two, okay, you come up with this total cost line or graph or curve, right? And the bottom part here would be the part where you minimize the cost. Okay, this is where the Q, which is the size, the order size, would be optimized at this level, okay, resulting in the lowest cost. Okay, this is a calculation example, right, for the EOQ. So with this carrying cost of 150 per unit, ordering cost of $50 per order, and the firm sells 100,000 units per year. Right? So you just put it into the EOQ formula, right? Find the order size, the optimal order size, which is 2582. So with 2582, the total carrying cost will be, you average it by dividing into 2 and multiply by the carrying cost per unit. So you would incur 1,936 in terms of storage or inventory cost. In terms of reordering or restocking costs, okay, it comes to 1936.48, about the same, right? So, okay, this is EOQ. All right, of course you need to take into account or consider the safety stocks, okay, so that you have a certain minimum level, okay, always available in your warehouse, right? And also the reorder points here also needs to take into account the time, okay, the timing, okay, in which the supplier can send you or furnish you with the raw materials. Okay. For direct demand, the two most famous are materials requirements planning and also just-in-time inventory. But again, it depends on the type of business, okay, or the industry, or the nature, okay, of business, because not all business would be suitable for just-in-time method, for example. Right? So you need to look at the specific needs, okay, and also the nature of the business. Right. Finally, we look at the accounts receivable. This has got to do with the credit policy, your own, the company's own credit policy, in terms of how flexible or restrictive the company in granting credit to its customer. Okay? So there is also a trade-off. If let's say you don't offer any discount, right, you may lose out certain proportion of customer. So you may lose some demand for your product. But if let's say you are too flexible, you are granting high discount or also longer uh, credit term, you allow your customer to repay or to pay you in a longer period of time, there is a probability of default. So although demand will increase, right, we'll get more customers, but there is a possibility of default. Now, for credit terms, normally it's expressed like this: 2/10 net 45, for example. 2/10 net 45 means company offers 2% discount if it is paid within 10 days. Right? The whole credit note, is 45 days. So you have a maximum of 45 days to settle your bill. Okay? The whole period is 45, but a discount is offered if you pay 10 days or less. Okay? And the discount is 2%. Right? So for example, if let's say the customer purchased $500 worth of merchandise, right? And with this credit terms, right? So you deduct the 2% discount, the customer would have to pay 490, right? If they pay within 10 days. Okay? If they pay after day 10, okay? But of course, within the 45 days period, you have to pay full, which is 500. So what this means is that if you take the discount, right, you pay 490. But if you don't take the discount, right, effectively what it means is that you are actually, in this sense, borrow from the seller. You borrow in the sense that you forego the opportunity to get the 2% discount for the remaining uh, period, for the remaining portion of this credit period. Okay, so the whole credit period is 45 days, but the effective borrowing period is actually 45 minus 10, which is 35 days. Because the first 10 days you are eligible for the discount. Okay, why do we look at it from this angle? Because we are interested to look at what would be the effective rate of this particular financing facility. Okay, in this case, we call it a facility, okay, which is a financing facility, because in effect, you are actually financing uh, the, the product that you are buying from the supplier. Okay? So in order to calculate the effective annual rate, or what we call the implied interest rate for this case, right, first and foremost, you need to calculate the 2%. The 2% nominal discount rate is equivalent to what is the corresponding rate given, right, given the product, okay, given the discount offered. So since the discount is 2%, okay, so you are actually paying 98%, okay, of the value of the product, because you take advantage of the 2% discount. So you will get this 2% discount. So 2 out of 98 is 2.0408%. But this rate, remember our time value of money, okay, refers to that particular period, okay, the period, okay, in which the financing occurs. Okay. But to calculate the effective annual rate, you need to annualize them. Okay, you need to annualize it to come up with an effective annual rate, which is more accurate for the annualized figure, okay, for an annual figure. So remember I said earlier, the borrowing period is effectively 35 days. And this 35 days, okay, if let's say this is, you assume that this is repetitive, meaning after this one term, you buy the same product from the same company, you have the same discount offer, okay, you deploy it, okay, so on and so forth. So during that year, you will have an equivalent of 10.4286 periods. 10.4286 credit periods, okay, for this particular or this specific credit periods, right? So remember our formula for effective annual rate, okay, 1 plus m to the power of 1 plus 1 plus j divided by m over m. Your m here stands for the periods. Okay, the periods per year is equivalent to the how many times it is compounded in a year. Okay, your m a year. And 1 plus I divided by m. This is your period rate. Okay, the periodic rate. Okay, what is the percentage of the rate within or in that particular period? So this comes to 0.2345 or 23.45%. Okay, so the 2% discount offered for the first 10 days for a credit note in which the total period or the period of the note is 45 days. The effective annual rate of this credit note with this discount is actually 23.45%. So it is not that cheap. Okay, it is actually not that cheap, although the 2% initially looks small. It looks something that you can, ignore, take for granted. Okay, in reality, it's not. Okay, it is quite costly for you not to take the discount. Okay, so this is the cost to you if you don't take the discount, okay, and pay after day 10. But of course, you need to look at the implications, right? You need to examine and assess the cost and the benefits of credit policy of a discount, right? Because you want to um, increase the demand, that's why you offer discount, right? But of course, there is the disadvantage and cost as well, right? Again, as I said, there is a possibility of default or non-payment, okay, by your customer if your credit policy is too flexible. Can we assess this? Yes, there is actually a way of calculating the so-called optimal credit policy, or how much discount and how long, okay, in terms of the term, okay, the collection period that you extend, okay, the credit you like to extend to your customer. This is much similar to what we do the inventory, but from this perspective, from this accounts receivable perspective, we call it the total cost of granting credit. Okay, meaning for you to create receivables. So your carrying cost would be the required return. Okay, how much can you generate, okay, on the receivables? Bad debts, okay, loss from bad debts, and cost of managing credit and collection. This all entail cost, and it is regarded as a carrying cost in this respect. Okay, your shortage cost would be your lost sales due to restrictive credit policy. So if it is too credit, okay, this is your cost. If you're too flexible, this will be your cost. So there is a trade-off, and you need to find the optimal, okay, the optimal level for your credit policy. Okay. So this is the chart, which is quite similar to the one we saw in the inventory, okay, between the carrying costs and also this ordering, or we call it opportunity cost, okay, for accounts receivable cost that you lose due to being too restrictive, right? Right, and can we calculate the NPV? Later, I show you how to calculate the NPV. But for now, let's see if you want to assess before granting credit. Of course, you would need to assess your potential customers, okay, before granting them or extending the credit facility to them. The most famous would be the 5 Cs, which originally used by the banks for loans applications, okay, and also credit scoring. So depending on the business, the size of the order, right, and whatnot, you would apply some of these analysis, credit analysis. So this is an example of how you can calculate the NPV. Okay, if you offer if you offer a discount, okay, you're granting a credit to your customer. So there are two scenarios here, two cases. The first one would be if you extend the facility to a new customer. So a new customer means you treat it as a one-off, one-off transaction or one-off item. Reason being because you are not sure yet whether the customer would come back to you with rebate. Okay, so by being conservative, you assume that this is a one-off transaction or issue. So the basic, the NPV formula would be this negative V here. V here refers to the variable cost per unit. The only relevant measure or item here is the incremental item. Okay, this is consistent with the incremental cash flow concept when we do capital budgeting. So that's why we don't look at the fixed cost. Okay, because fixed cost, no matter what, right, it will still be there. Okay, no matter how many customers, new customers come in, you will still incur that same level of fixed cost. That's why it is not incremental. But your variable cost per unit will change depending on the demand on the number of customers or number of products sold, right? And then plus 1 minus the pi here. The pi symbol here refers to the probability of default. Okay? Say based on certain database or on certain actuaries or economists, right? Figures come up with a certain probability of default for businesses, and let's say it is available, and the probability here is 15%. It is a probability of default. Okay? For every 100 customers, there is a probability of 15 of them default, not being able to repay, okay, to pay you what they owe you, meaning you are unable to collect the receivables. And the dollar sign here refer to the price, right? The price, right? And the monthly required return is 1%. Okay, monthly required return is 1%. Okay. This refers to how much you are offering in terms of the discount to the customer. So putting in the figures in the formula, you will see that the NPV is 42.57. And by setting the NPV equals to 0, you can determine the probability of default, meaning what would be the maximum probability of default that can still be allowed or can still be possible for you to get a break-even NPV, which is NPV equals to 0. So the figure is quite high. The probability is 54.09%, meaning that even if the probability of default, provided that the rest remains the same, okay, you would still get a 0 NPV. Okay? So anything below would result in a positive NPV. So this is applied on a new customer scenario. But if it is a repeat customer, it's a slightly different, whereby, okay, notice that in the one-off customer here, the new customer, when you discount it, you divide by 1.01. 1.01 here refers to 1 plus the rate, the monthly rate, because you treat this as a single amount. A single amount due to the fact that this is for new customer. But if it is repeat customer, you treat it as a perpetuity. And since it is a perpetuity, right, you divide by the rate 0.01 instead of 1 plus 0.01. You remember the present value of perpetuity last time. So notice that the NPV is much higher logically, because this is for repeat customer and you treat it as a perpetuity. So it is 5,000. That's why comparing the new key customer, which is you treat it as a single one-off, you know, transaction or item, compared to the NPV of a repeat customer, which is 5,000. That's why companies should focus on um, the loyal customers. Okay? That's why companies have many loyal customers programs in order to entice, in order to attract the customers to come again, okay, to be a repeat buyer. Okay? In this case, because the NPV is much greater, right? And this is the credit info, okay, that you can access to in order to check on your customers before granting them credit. This is the 5 C's that the banks normally use. Okay? And yeah, in terms of collection, you need to monitor the receivables. Right? There is a famous aging schedule mechanism where you come up with a schedule, detailed schedule, right? Sometimes certain companies do monthly, on a monthly basis. Some even more aggressively do on weekly basis. So they keep track of the receivables so that they can identify. Okay, they can first of all they can look at, okay, they can categorize the customer, right? Let's say more than 1 year old, right? Then you divide into, let's say, 8 to 12 months. Okay, then 6 to 8 months, so on and so forth, right? And you also prioritize in terms of the value or the amount of staples. And this is how you mechanism of collecting is starting from warning, or if it is it has become serious or too, right, too old, then the receiver has become too old or surpass certain limit in terms of the timing. Okay, you pursue legal action, okay, if necessary. And then you have to look at the also the uh, compare it against the inventory period as well as the payables period. Okay, that's why we look at the big picture just now, the operating cycle and also the cash cycle. And you match it against the, let's say, how long it takes for you to pay your supplier compared to how long it takes for you to collect from your customer. Okay, so you want the former to be longer than the later. Okay, you want to um, pay to the supplier longer than what it takes for you to collect your customer. So then only it will make a business sense. Okay, right? And also you also have, compare it with, against the industry or sector standards, okay, particularly against your competitors, and to see whether you are lagging behind or are you ahead, right, in terms of payables and also in terms of collecting your receivables. These are some of questions I have. I think about 12 questions. Next, okay, some of cash management, accounts receivable, even inventory management as well. You can try this on your own first, okay, as many as you can. Okay, I will provide you with the answers later. Okay, if we have time, we will discuss it in class. Right? Okay, the last topic would be financial analysis and planning. I will use the module that you get that the PBS has prepared. Right? And the first part of this topic is basically the financial ratios, okay, which we have done in the earlier chapter. If you look at the ratios, okay, all of this you have done this, so it shouldn't be any problem. Also, there is although there is some differences in terms of the names. For example, the average collection period or days in receivable. It is called days sales outstanding. Okay? But it is basically the average collection period. Okay, no issue. Right, and we have all the standard ratios. But I believe the one that I have given you slightly more, I think, right? Uh, yeah, there are an additional price to cash flow, okay, in addition to price to earnings. So here we compare the stock price to the cash flow per share. Okay, this is trend analysis. We look at the trend. Okay. Now, in terms of comparative, you compare with the other companies, okay, or within the sector. Okay, we look at the question afterwards, okay, on how to interpret or to comment on the differences. Okay, but now look at the limitations. Okay, these are some of the limitations of financial ratios, although there are quite a number of so-called limitations. Okay, it doesn't hinder the analyst from using financial ratio as a means of analyzing company because we uh, lack of other means, right? So this is sometimes it's the only resort that we have, right? And it has many strengths as well. Okay, the weaknesses or limitation it depends on uh, the context and also the scenarios as well. Okay? Say for example, most of the ratios are historical in nature. You use historical data, okay? But then again, some of the historical performance things that have occurred historically or in the past, okay, can stand or can be an indication as to the future performance. Okay, it can be repeated, so although not in all cases. Right? And having said that, we also have market value ratios, right, in order to compensate this limitation. Then there is this accounting issue of current or market value versus the historical cost, okay, or historical value. And the other thing is that when we do a forecast, okay, there's inflation that comes into the picture. Of course, if it's over 1 year, okay, when we want to compare within 2 years period, this effect may be negligible. But if we do for a longer time period, so we need to maybe take into account inflation. Then in terms of the accounting practices and procedures that may have changed over time, so it may have an implication to the financial metrics keep being used in the financial statement, right? And changes in terms of the organizational, okay, such as the structure, the business and whatnot, it may also change the how you interpret the ratios. And then the permanent and seasonal variables, you need to separate them and focus only on the permanent, okay, because seasonal may not be accurate or may not be there permanently, definitely, right? And it can also be uh, attributable to exceptional or extraordinary items, okay, that does not occur every year, for example, okay, or consistently. And finally, this is what we have discussed in terms of the earnings management. Okay, they call this manipulation. Okay, it's a strong word. It may not be manipulation, but it can be earnings management. Okay, so management want to portray a good financial performance, okay, a good outcome, so they can taint or manipulate the figures. Right? So these are among the weaknesses of financial ratios. So you need to use the ratios cautiously, right? And to take into account the limitations. Now for financial planning, right? It, it it depends on one company to the other. Okay, what the module, okay, or the book provides is the general guideline, okay, where you need to have objectives, okay, and what are the elements that you need to have or you need to consider, okay, before setting your objectives, right? Among others, the investment opportunities that the firm have, right, in store, and then your leverage. Okay, at the moment, what is your indebtedness or leverage level, right? And in terms of your cash capability, okay, your cash flow is vital here. Okay, it's very important. Okay? And what are examples of objectives of financial planning? Okay. Okay, the objective of financial planning is, of course, to determine, to ascertain, okay, that you would have a sufficient amount of funds, right, to operate. Okay, and it should be sustainable. Okay, and second objective would be to avoid wastage. Okay? You do not want to waste resources, right? Certain capital raising of capital may not be necessary. Okay? So you raise capital only when you really need it. Okay, and why is it important? Okay, these are among the points, okay, of the importance of financial planning in terms of optimal funding, right? And we have discussed earlier on the capital structure, right? How value can be added, value added can occur with the optimal capital structure in the portion between debt and equity. Right? And then you want to finance the right projects that can provide you with the highest positive NPV. We discussed it in capital budgeting. Okay. And confidence to the investor as a signal, okay, to the investors that you are doing the right thing and heading into the right direction, and to survive during difficult times. Okay. And also, you would want to match, okay, or link present with the future. Whatever that you are forming at the moment, okay, is an indication, okay, pave the way into how you would grow, okay, into the future. Finally, to determine the operational requirements. Okay. Once you want to set into the capital investment project, for example, there are certain needs in terms of the working capital, right? For example, so this you would fill in the measure, estimate your requirements. Okay, now as when you want to set into the capital investment project in the future. So what do we normally have in the financial plan? You start with a sales forecast, right? And then you build the pro forma statements. Okay. Say, for example, you want to start June or July. Okay, now it's July, right? Okay, so you want to start forecasting. You want to build the model, okay, the sales and profit model, right? So for next year would be the first year that you forecast it. The forecast data begins next year. Okay? So whatever that comes in this year, right? 6 months has passed. Okay, 6 months have passed, historical already, but there are still 6 months into the year. So you build your pro forma statements, and from there you build the forecast statement, okay, or the earnings model, if you will. Okay. And from there you will determine, okay, how much you require in terms of the assets, particularly the fixed asset or the capital expenditure, okay, in order to support the cash flow forecast. And in terms of financing, okay, how would you finance the capital budgeting? Okay? How would you finance it? Would you borrow or issue equity, right? And you should also take into account the dividend that you want to declare or pay for that year. Okay? And for certain companies, they have what we call the target debt to equity ratio. Okay? They have a target capital structure already. And if let's say they want to maintain that target capital structure, how would they go about in terms of financing. Okay, there's a certain amount that they can go for, okay, for debt, for example, as well as equity, and all this is done on the back of assumptions. Okay, and more times than not, you would need certain economic assumptions, okay, to go into the forecast into the future. Okay. So this example is on this company where we have their balance sheet and also the income statement, and you need to calculate all these ratios, right? And then the industry average is given on the right hand side. Okay, let's say, for example, your current ratio for this company is 2.01, okay, and it is the same as the industry average. So there is no difference, okay, with the industry average. And if you look at the average collection period, there is a difference because the industry average is only 35 days, but the company takes about 77 days, okay, to collect its receivable. Okay, and this is a bad sign. Okay, so the company needs to improvise on this, and one of the ways is to look back at the credit policy. It may have a very flexible credit policy by extending or granting um, credit to the customer, a longer credit period to the customer. The rest are about the same, right? Um, let's look at the other. Okay, if the profitability is about the same, okay, except that the ROE, I think, is okay, much lower, 6.4% compared to the 9% of the industry average. Right? So the company, in terms of profitability, is much lower than the average in the industry. Okay, so they need to work harder on the costing, okay, in order to minimize the cost, okay, particularly the cost of goods sold and the operating expenses of the company. Debt ratio and also the debt to equity and also the total debt ratio is about the same as the industry average, right? So that's all for this big, right? We will work out a mini case study and also some of the questions, okay, during class this week.